Let us analyze our sixth transaction. Rohan buys equipment worth $1,900 on credit. We will keep in mind that every accounting transaction follows the double entry system, where each transaction involves at least one debit and one credit entry. This system ensures that the accounting equation assets equals to liabilities plus equity remains in balance. In other words, the total debits must equal the total credits for every transaction. Since Rohan buys some equipment for $1,900 on credit, assets in the form of equipment will go up by $1,900. At the same time, since the equipment are bought on credit, liabilities will also go up by $1,900. This is kind of loan taken, which Rohan must pay off in the future. We must remember that increase in any asset account is a debit entry, whereas increase in any liabilities account is a credit entry. And of course, vice versa. And there is no effect on owner's equity for this transaction. The lesson from this transaction is, when you buy anything on credit, you create an obligation to pay it off in the future. If you buy an asset on credit, your assets and liabilities go up simultaneously. If you buy services on credit, your liability goes up while your equity goes down.